One of the best long-term investment strategies to help ensure you achieve long-term gains is investing in companies of varying sizes and risk, and understanding market cap can help you do just that. Hey guys, it's Adam here, and in this video I'll be discussing what the market cap is, the different levels of market cap, and how investors use market cap when analysing stocks. So market cap, which stands for market capitalisation, is a very simple and useful indicator, and it refers to the total value of a company's stock. You can calculate a company's market cap very easily. Simply multiply the number of shares outstanding by its current market price. So for example, Company X has 1 million shares outstanding and its current market price is $10. Company X's market cap would be $10 million. You can also calculate a company's market cap using what's called a Freeflow Method. This is where you only use shares that are traded on the market, so you wouldn't include any locked-in shares such as those held by the government or any held by executives in the company. Therefore, the formula to calculate the free float market cap of a company would be the share price multiplied by the difference between the number of shares issued and the locked-in shares. This method is used by indices such as the S&P 500 as it gives a better indication of market movements and how many shares are readily available for investors to buy. The free float is also inversely correlated to volatility, which means that the larger the market cap, the lower the volatility and by extension the risk. Most commonly, there are three categories of market cap a company can fall into: large cap, mid cap and small cap. Large cap companies have a market cap of around 10 billion or more and have usually been around for a long while and have good standing in their market, such as Boeing, with a market share currently of around $85 billion. These companies tend to be market leaders, generating substantial profits and taking up a large proportion of the market they operate in. While investing in large cap companies might not generate massive returns in the short term, it does however pose less risk than investing in mid cap or small cap companies, and typically large cap companies reward their investors with consistently increasing dividend payments and share price. Mid cap companies have a market share of around $2 and $10 billion and are usually well established in the market they operate in, but still have a lot of room for growth, such as Canada Goose. Mid-cap companies carry higher risk than large-cap companies, mainly because they're not as well established, but because of their high growth potential, they could provide higher returns, driving their share price up. Interestingly, mid-cap companies have actually historically outperformed large-cap and small-cap companies on average. However, with that being said, it's very important to look into a mid-cap company's history, as it could be the case that rather than still being in their high growth potential stage, they're actually coming to the end of it and reaching their maximum potential. Finally, small cap companies have a market cap of between $300 million and $2 billion. Small cap companies tend to be newer and younger companies compared to their mid cap and large cap counterparts, and they tend to be in niche or emerging markets. They have considerable growth potential and are by far the most risky and aggressive of the three. This is because on one hand they may provide substantial returns for any investor who is willing to ride out the volatile stock swings in the short term. However, on the other hand, they carry a lot of risk. This is because of their age, susceptibility to economic turndown, uncertainty and vulnerability to competition, especially if they're in a market with lots of large cap companies. But why is market cap an important concept to grasp? Well, it allows an investor to compare the different sizes of different companies. It also allows an investor to diversify their portfolio by including companies with varying levels of risk and return. You've heard the saying, don't put all your eggs in one basket. Well, the same principle applies when investing in companies. You should have a mix of large cap, mid cap and small cap companies in your portfolio, and this will help reduce the overall level of risk and best enable you to reach your long-term investment goals. It also acts as an indicator of the market's perception of a company going forward due to the price investors are willing to pay for a share in the company. A company's market cap can also indicate the market's perception of how that company will perform going forward, since it measures how much investors are willing to pay for a share in the company. So what can impact a company's market cap? First off, any change to the market share price can have a serious impact on a company's market cap. This could be caused exogenously through a market crash or a recession, but could also be caused endogenously through a company's issue of warrants. The issue and exercise of warrants increases the number of shares outstanding, diluting the current market value of those shares, thus reducing the market cap. I really hope you enjoyed this video and learned something new. If you want to see more videos like this, please consider liking and subscribing. And if you want to know more about what the PE ratio is and how you can use it when analysing stocks, click on the link to the video before. Thanks for watching.